What is debt to income ratio, or your DTI? There's a lot of acronyms in the mortgage business, so it's important for us to tell you and explain what they are so you don't get confused. Your debt to income ratio is one of the most important calculations that a lender is going to do. When you get qualified for a mortgage, there's three different buckets or silos that we look at. There's your credit. Do you meet the minimum credit score? Are there any issues there? There's your assets. Do you have the money needed for the transaction? And then there's your debt to income ratio. We're really looking at closely what you make and what your debts are, so we can determine how much of a mortgage you actually qualify for. So you can see why that's a really important one in the total equation. How do we calculate debt to income ratio? So if you're a wage earner, you get a W-2 and you get a salary or an hourly wage, we're going to take your gross income. If you're self-employed, it's a little bit different. We're going to take your net income after expenses and write-offs. Either way, once we come up with the correct number for your picture, then we're going to look at your monthly debt obligations. But there's an important note on this. We're only looking at debts on your consumer credit report, okay? So meaning we're not looking at your grocery bill, we're not looking at your gas bill or your cell phone bill. Only things on credit like credit cards, student loans, auto payments, maybe something you co-sign for, okay? So I'm now going to give you a real life example of how we do this. If you made $8,000 a month gross, that's about $96,000 a year. And lending guidelines typically say between 40 and 50% debt to income ratio is the maximum that we're going to allow. So that's how we're going to determine how much we can loan you. Let's go in the middle for this example and call it a 45% debt to income ratio. On an $8,000 a month income, 45% of that is $3,600. That gives me $3,600 that I can now use to incorporate all of those monthly debts on your credit we just talked about, plus the new proposed mortgage payment. So let's break that down even further so it makes sense. If I've got $3,600 that I can use, and you've got a $500 car payment and a $1,500 in student loans and credit cards, that's going to leave me a little bit less than $2,000 that I can use for your new mortgage payment, which is going to equate to about a $400,000 loan, give or take. So it gives you an idea of how quickly we can do this. The good news is this is a very easy thing for us to do. We don't have to dig through all your paperwork and be on the phone for an hour. We can, over a few quick emails or a 10-minute phone call, get some just basic topical information from you, calculate your DTI ratio, and give you a pretty good idea of what kind of a range of a home you can buy or how much you can borrow on a refinance.